Okay, let's unpack this. Welcome everyone to a deep dive into the whirlwind world of crypto assets.
Hi there. Yeah, it's definitely a fast-moving space.
We're looking at how they're being governed, or how people are trying to govern them, and also how businesses are actually starting to put them to use.
Which are two sides of the same coin, really. The rules shape the use cases.
Exactly. You know how crypto is it's everywhere, constantly hitting the headlines.
Oh yeah, impossible to ignore.
Well, while all that noise is happening, the actual rules are still kind of being figured out globally.
It's very much a work in progress.
And companies, they're trying to navigate this and see, what can we actually do with crypto beyond just like holding it as an investment?
It's a really dynamic landscape, isn't it? You've got technology, finance, regulation, all sort of colliding.
Definitely. Regulators are trying to draw some lines in the sand.
While businesses are out there exploring the practical possibilities, sometimes pushing the boundaries.
Right. And to really get a handle on what's happening, we've pulled together some interesting sources,
There's a big global regulatory study from Cambridge Judge Business School.
which gives that really broad overview.
Yeah. And then we've got articles from places like Stormgain and Deloitte looking at more specific things.
Like microtransactions, that's a fascinating one. And the bigger picture of how corporations are starting to adopt crypto.
So our mission today really is to cut through some of that complexity.
Yeah, try and make sense of it for you.
We want to show you how authorities around the world are grappling with regulating this stuff.
What this kind of patchwork of rules might mean for you, whether you're just curious or maybe even using crypto.
And maybe the most interesting part for some, how companies are moving past the hype.
Right, past the speculation and into actual operations.
Exactly. So let's dig into what these sources actually reveal.
Okay, so picking up on that point about the global rules, that Cambridge study paints a really varied picture, doesn't it?
Oh, absolutely. The divergence is maybe the biggest headline.
How so?
Well, the study basically sorts jurisdictions into three main buckets based on how they approach crypto activities.
Okay, what are the buckets?
So first, you've got a pretty big chunk, about 43% of places they looked at, where crypto is still largely unregulated.
Still kind of the Wild West in some places then.
You could say that. Then there's a smaller group, around 12.6%, that have gone the other way and implemented outright bans.
Okay, banned entirely. And the rest?
The rest are regulating. That's the biggest group, actually 44.1%.
Ah, so regulation is actually the most common approach now.
It is, but here's where it gets really interesting. Within that group that regulates,
Yeah.
a big majority, 35.3%, have gone for comprehensive frameworks. We're talking licenses, detailed rules, the whole shebang.
Wow, okay. Compared to what?
Compared to just 8.8% whose regulations are basically limited to just anti-money laundering AML controls.
That feels like a pretty significant shift, doesn't it? Moving from ignoring it or banning it to building detailed rule books.
It really does.
So why the big push for regulation globally now? What's driving it?
It really points to this critical balancing act regulators are constantly performing.
Balancing what?
Well, they're trying to protect consumers, right? Protect investors from fraud, volatility,
Such obvious risks.
maintain market integrity, prevent financial crime, AML, CFT, all that. And crucially, ensure financial stability. But
There's always a but.
there is. They also often want to avoid crushing the very innovation that crypto might offer.
So it's that classic innovation versus safety dilemma.
Precisely. And navigating those often competing goals, that's really what's pushing this regulatory wave now.
And the sources also flag that even just talking about this stuff is hard because nobody agrees on the words.
Oh, definitely. The terminology is all over the map, how one country defines a crypto asset versus a virtual asset. It varies wildly.
So what term does the Cambridge report use?
They use crypto asset as a kind of broad umbrella term for privately issued assets using cryptography or DLT.
But they're clear. That's not like a legal standard everywhere.
Exactly. They make that clear. And they also define other key terms you hear a lot, like CASP,
Which is that?
crypto asset service provider, think exchanges, wallet providers,
Nada.
and different types of assets like payment tokens, security tokens, NFTs, even CBDCs, central bank digital currencies.
Right. Getting the language straight is fundamental, but it sounds like the world isn't quite there yet.
Not even close, really. It's a challenge.
Okay, so we've got these assets, these CASPs, dealing with them.
Yeah.
How do rules actually start getting applied when it comes to, say, listing them on trading platforms?
Well, the sources show two main ways this is happening globally. Two models for deciding which crypto assets can be traded.
Okay, what are they?
Model 1 is pre-approval. Basically, a regulator or maybe a self-regulatory body they designate has to give the thumbs up before an exchange can list a specific crypto asset.
So the regulator decides up front. Where do we see that?
Japan is one example they cite, and the UAE's Financial Services Regulatory Authority, the FSRA, is another.
That sounds pretty strict. Like a high barrier to entry for new coins?
It can be. The alternative model puts the responsibility squarely on the platform itself.
How does that work?
The exchange or service provider has to do its own assessment. They look at the crypto asset, check it against the regulatory criteria, and decide if it's eligible to be listed.
Ah, okay, so the compliance burden shifts to the business in that case.
Exactly. It's a different philosophy.
Now, beyond just getting listed, the sources mentioned something I found really interesting, maybe a bit unexpected: sustainability disclosures.
Yes. This is definitely a sign that crypto regulation is maturing, broadening its scope beyond just financial risk.
And the EU is leading on this.
It seems so, yeah, with their MiCA regulation markets in crypto assets.
What does MiCA require?
Starting potentially as soon as January 2025, issuers of crypto assets and the CASPs dealing with them will need to publish information about the environmental impact.
Environmental impact, like what specifically?
We're talking about adverse impacts on climate and the environment. Things like energy consumption.
Okay, the big one everyone talks about.
Right. Greenhouse gas emissions, both direct from their operations and indirect, like from the energy they purchase. Even waste generation, especially electronic waste from mining rigs or servers.
Wow. And does it relate to how the crypto works, like proof of work versus proof of stake?
Yes, the reporting needs to consider the consensus mechanism. That's a clear nod to the fact that different mechanisms have vastly different energy footprints.
And you mentioned the UK is looking at this too.
Yeah, the report notes the UK is considering similar disclosures and pushing for international standards on this.
So as a listener, why should you care about this environmental reporting?
Well, it brings a whole new layer of transparency, doesn't it? Just like you might look at the environmental footprint of a company you invest in or a product you buy.
Right.
Soon, you might have standardized data to consider the environmental impact of the crypto assets you hold or the platforms you use. It connects crypto to broader sustainability goals.
Okay, interesting. Let's shift gears slightly to stablecoins. They feel, I don't know, like a really fundamental part of the crypto plumbing, but also a big focus for regulators.
Absolutely. Stablecoins are, crypto assets designed to keep a stable value, usually pegged to something like the US dollar.
And those dollar-pegged ones dominate. Right.
Massively. The sources say USD stablecoins are over 99% of the market. USDT, Tether, and USDC are the big players.
We mostly hear about them being used for trading, like moving between Bitcoin and Ethereum without cashing out to dollars. Is that the main thing?
That's definitely a huge use case. They act as a bridge for trading, yeah. Also a hedge against volatility within the crypto market, and they're widely used as collateral in DeFi, decentralized finance.
Okay.
But the sources show they have a much wider impact, sometimes in surprising ways.
Like what?
Well, they've reportedly been used in things like sanctions evasion,
Oh, interesting.
circumventing strict capital controls in some countries, providing a hedge against local currency collapsing, especially in emerging economies.
So people using them to protect their savings.
Potentially, yes. And also for cross-border payments, remittances, even facilitating donations and humanitarian aid.
Wow, okay. That really broadens the picture beyond just crypto traders.
It does.
But there are risks. The sources talk about risks too.
Oh, absolutely. You can't talk about stablecoins without mentioning the collapse of Terra USD back in 2022.
Right, the algorithmic one that failed spectacularly.
Exactly. That really highlighted the fragility, particularly of algorithmic stablecoins, and how quickly confidence can just evaporate.
And regulators worry about that.
They worry about those confidence effects spreading, yeah. And potential risks to the wider financial system if these stablecoin arrangements become really large and interconnected with traditional finance.
So how are they tackling those risks? Well, what are the rules looking like?
The main focus right now is on those stablecoins that are pegged to fiat currencies and are supposed to be backed by reserves, like actual dollars or safe assets.
Okay, the more traditional kind, if you can say that about stablecoins.
Relatively speaking, yes. Global bodies like the Financial Stability Board, the FSB, have put out recommendations.
And individual countries.
We're seeing specific rules emerge. Japan, for example, has rules for what they call digital money types stablecoins, requiring strong backing with deposits or safe assets. Singapore's also built a framework. They're trying to allow onshore issuance while managing the risks from stablecoins coming in from offshore.
And what about the more experimental types, like algorithmic ones?
Generally, regulators are much more cautious there. Hong Kong, for instance, has stated they won't authorize algorithmic stablecoins for now.
Okay, so focusing on the ones that look most like traditional money first.
That seems to be the priority.
Got it. So we've got rules emerging around the assets themselves, especially stablecoins.
Yeah.
What about the companies providing the services, the CASPs you mentioned?
Right, the crypto asset service providers. They're really the gatekeepers for most users, aren't they?
Yeah, the exchanges, the wallet providers.
Exactly. They offer services like buying and selling crypto, transferring it, holding your private keys securely, that's safekeeping, and increasingly other financial services built on crypto.
Like staking. I hear that term a lot.
Staking is a good example. That's where users lock up their tokens to help secure a proof-of-stake network.
And they get rewards for doing that.
Usually, yes. They act as validators, and there are often penalties, slashing, if they misbehave. CASPs often facilitate this for users.
And these CASPs are a key focus for regulation because they're the main touch point for users where a lot of the risks can actually happen.
That's exactly it. Regulating the CASPs is seen as crucial for managing risk across the whole ecosystem. It provides a regulated entry point and ensures they follow rules like AML-CFT.
Okay, that gives us a pretty good map of the main regulatory highways.
Yeah.
But what about the trickier off-road areas like DeFi and this whole issue of crypto being global while regulation is national?
Yeah, DeFi regulation is, well, it's arguably one of the thorniest issues.
Why is this so hard?
Because DeFi protocols aim to do many of the same things as traditional finance lending, borrowing, trading, but using automated code, smart contracts, running on decentralized blockchains.
Right, so there's no central company or CEO to regulate.
That's the core challenge. Who do you hold accountable if a protocol fails or gets exploited?
And the smart contracts themselves aren't necessarily like legal contracts.
Not in the traditional sense, no. Code is code, but legal enforceability is another question. This makes applying existing legal frameworks really difficult.
So how are regulators even approaching this?
We're seeing different experiments. The sources mention the UAE's ADGM, a financial free zone in Abu Dhabi.
What are they doing?
They've tried to bring DAO's decentralized autonomous organizations into the regulatory fold by letting them register as something called DLT foundations.
Okay, what does that mean?
It means these DAOs need to have formal charters, governance structures, reporting requirements, basically trying to create a legal entity you can regulate.
Interesting. Kind of putting a traditional wrapper on a decentralized thing.
It's one approach, yeah, trying to create a point of legal contact.
And other places.
Well, contrast that with the UK's position, which the source notes is basically that specific DeFi regulation is probably premature. They favor more international discussion first.
So a wait-and-see approach.
Pretty much. It really highlights that fundamental tension. How do you balance the potential benefits of decentralization with the need for consumer protection and, basic accountability?
Yeah, that's a tough one. And the other challenge, you mentioned crypto operating across borders.
Yeah.
How does that play out with national regulators?
It's a huge headache for them. You have platforms based maybe in lightly regulated jurisdictions offering services globally via the internet.
Right. Reaching customers anywhere.
And sometimes taking a, let's say, relaxed approach to complying with the rules in every single country they operate in.
So how do regulators try and stop that? The sources mention reverse solicitation.
Yes, and this is often misunderstood. The EU example is used to clarify it.
It sounds like if I, as a customer, go find a foreign platform myself, they don't need to follow my local rules.
That's the common misconception, but the EU guidelines push back on that interpretation.
Okay.
It's better understood as a prohibition on foreign firms actively soliciting clients in the EU unless the client genuinely initiated the contact entirely on their own with no prompting.
So if the company targets ads at me or sends me personalized emails, that's not reverse solicitation.
Generally, no. The guidelines suggest that kind of activity means the firm is targeting EU residents and likely needs to be authorized locally.
So it's not really a loophole for companies. It's a rule designed to stop them actively marketing in places where they aren't licensed.
Exactly. It's an attempt to assert jurisdictional control in a borderless digital world. It's tough to enforce, but that's the principle.
That makes a lot more sense. Okay, let's pivot now to user protection, especially for retail investors. The sources are pretty clear they're particularly vulnerable here.
Yes, very much so. Retail investors face a whole cluster of risks.
What are the main ones?
Volatility is flagged as the #1 risk. Just the sheer speed and size of price swings can lead to huge losses very quickly.
Yeah, we've all seen those charts.
Then there's misleading advertising and just a massive information asymmetry. Investors might not really understand the tech, the risks, what they're actually buying.
And the sources mention specific targeting of vulnerable people.
Yes, there's real concern about platforms or promoters targeting less financially savvy groups, maybe older people, or those in difficult financial situations with unrealistic promises of getting rich quick.
Mm-hmm.
Social media kind of amplifies this, playing on FOMO, fear of missing out, and sometimes encouraging almost gambling-like behavior.
And unlike traditional finance, there often aren't the same intermediaries or safety nets.
Right, you might lack those trusted intermediaries, clear governance structures in some projects, and crucially, often there's very little recourse if you lose your money or get scammed.
The sources list some other specific risks too, right?
Yeah, things like outright fraud, platforms pushing unsuitable products, technical issues with the platforms themselves, lack of transparency about fees or operations, data loss, and the risk of the provider just going bust.
Okay, that's quite a list of potential dangers.
Yeah.
So what are regulators actually doing to try and protect retail investors from all this?
It's really a multi-pronged approach. Education and warnings are a big part of it.
Like telling people to be careful?
Yes, but sometimes more specific. Authorities in Hong Kong publish lists of suspicious or unlicensed platforms. Nigeria and the Philippines have actually named specific platforms, like Binance, warning users about risks.
And financial literacy efforts.
Definitely. Many places are running campaigns, sometimes specifically about crypto risks, sometimes as part of broader financial education.
What about the advertising itself? That seems like a key entry point for many people.
Advertising is a huge focus, you're right. A baseline rule almost everywhere now is that ads must be clear, fair, and not misleading.
But some places go further.
Yes. The EU's MACA, for example, ties advertising rules back to the detailed white paper that crypto projects have to publish.
Okay.
Some national rules are even stricter. Spain requires companies to notify the regulator about major crypto ad campaigns beforehand.
And the UK.
The UK has brought crypto promotions under its existing, quite strict financial promotion rules. This means higher standards for direct offers to consumers.
Like what?
Things like mandatory cooling-off periods, checks to categorize the client's knowledge, appropriateness tests to see if they understand the risks.
Wow.
And importantly, unregistered firms are now completely banned from promoting crypto assets to UK consumers.
Okay. And are some regulators actually restricting who can invest or how much they can put in?
Yes, that's probably the most restrictive type of measure suitability or appropriateness assessments.
How do those work?
Basically, the platform or service provider has to check if a specific crypto product or investment is actually suitable for a particular investor.
Based on what?
Based on their financial situation, their investment objectives, their knowledge and experience with crypto, and their tolerance for risk. Practices vary a lot, though.
Can you give an example?
Hong Kong is a good one. After lifting an earlier ban on retail access, they brought in mandatory licensing for platforms and really strong safeguards.
Such as?
Platforms there have to assess a retail client's knowledge and risk profile to see if trading crypto is appropriate for them at all. They might limit how much exposure the client can have based on their finances.
Okay.
And they have to be really explicit that high-risk virtual assets are generally only suitable for people who can afford to lose their entire investment and have a high-risk tolerance.
So it's kind of like saying, you can come in, but we need to be sure you understand the risks and can actually afford to take them.
That's a good way to summarize it, yeah. It shifts a significant burden onto the service provider to actively assess and manage retail risk.
Okay, we spent a lot of time on the rules, the regulation, which is clearly moving fast. Let's shift gears now and look at the other side. How is crypto actually being used by businesses, moving beyond just speculation?
Right, and the Deloitte perspective here is interesting. It really emphasizes that companies are starting to think about crypto not just as something to hold on the balance sheet.
Like digital gold or something?
Exactly. But as a tool they can integrate into their actual day-to-day operations.
What's the appeal for a company to do that? What's the potential benefit?
Well, it could potentially open up completely new ways to conduct commerce. It could significantly broaden their market reach, allowing them to transact with maybe new customer segments or business partners who prefer using crypto, or maybe are only reachable via crypto.
But I imagine for, say, a traditional company's finance department, actually getting hands-on with crypto must feel like a huge leap.
Oh, it absolutely is, and Deloitte points out the challenges. You need really clear goals, otherwise the scope can just balloon.
Right.
You need specific expertise. How do you actually receive crypto, monitor it, manage the wallets, the keys?
Security must be a nightmare.
It's a major consideration. Then there's the custody decision. Do you manage it yourself, which requires serious tech know-how, or trust a third-party custodian?
Mm-hmm.
Companies also need to start thinking about crypto as its own distinct asset class, with unique accounting, tax, and risk implications, and even look ahead to things like CBDCs.
So it's definitely not as simple as just adding a Pay with Crypto button on your website.
Oh, far from it. It really requires coordination and buy-in across the whole organization. Finance, legal, risk management, IT, cybersecurity, even the board needs to be involved.
Sounds like a major project.
It can be. It needs strong leadership from the C-suite. But the good news, the sources suggest, is that companies can often approach this incrementally. Start small, maybe with a specific pilot project or use case.
And one very specific use case that gets mentioned where crypto seems like it could really solve a problem is microtransactions.
Absolutely. This comes up in the Stormgain source. Microtransactions are those really small payments, right? Often just cents, maybe a few dollars.
Yeah, like in online games for virtual items or tipping creators' content.
Exactly. Or maybe paying for individual news articles, things like that.
And the problem is traditional payment systems, credit cards, bank transfers, often have fees that make those tiny payments just not worth it.
Precisely. The fee might be more than the transaction value itself.
So crypto's potential here is basically faster and much, much cheaper small payments.
That's the core promise. The source lays out the key things a crypto needs to be good for this. Super high transaction speed, you want near instant confirmation.
Right, you don't want to wait minutes to buy a virtual sword.
Exactly. Very low transaction fees, obviously, so it's actually economical. High scalability, because you might be dealing with millions of tiny payments.
Mm-hmm.
And of course, it still needs to be secure and offer adequate privacy.
And they actually list several specific cryptocurrencies that are kind of designed with these features in mind.
Yes, they highlight a few potential candidates and why they might fit. Nano is one.
What's special about Nano?
It's designed to be feeless and fast, using a different structure called a block lattice, though they do note adoption challenges and some historical issues with spam attacks.
Okay. Who else?
Stellar, XLM. Known for very fast confirmation times, extremely low fees, it's focused a lot on cross-border payments and financial inclusion. Again, adoption is a hurdle.
I've heard of IOTA too, often linked with the Internet of Things.
That's right. IOTA uses something called the Tangle, which isn't technically a blockchain. It's a DAG-directed acyclic graph. It also aims for feeless, scalable transactions designed for machines paying machines in the IoT world. Adoption is key here, too.
Okay. What about Ripple XRP? Isn't that more for banks?
It's heavily focused on financial institutions, yes, but the tech itself offers very fast settlement like seconds and very low costs. Its large market cap gives it some existing network effect, though some people raise concerns about its level of centralization.
And Solana.
Yeah.
That one gets talked about a lot for speed.
SOL, yeah. Known for very high throughput, fast transactions, low costs. Definitely a contender on the tech specs for microtransactions. But it has had some notable network outages and stability issues in the past.
Right. Reliability is key.
Absolutely. Then there's Dash, which focuses on speed and low costs, has an instant send feature, low fees. But again, adoption challenges and some debate around its masternode structure and centralization.
And one more, Multiversus X.
Multiversus X, formerly Elrond, EGLD, highlighted for high throughput and low fees, using a technique called sharding to achieve scalability.
Okay, so looking at that list, the big takeaway seems to be that there isn't just one crypto that's perfect for everything. It's about different technologies being optimized for different jobs.
That's exactly it. It really shows the diversity within the DLT space. Different design choices, different trade-offs being made to prioritize speed or cost or scalability or decentralization for specific applications, like making these tiny payments actually work.
Right. Okay, wow. We've covered a lot of ground in this deep dive.
We really have. We've gone from the big picture of global regulation, the bans, the hands-off approaches, the move towards comprehensive rules.
Yeah, and the tricky balancing act regulators are facing.
Right. We looked at rules around the assets themselves, like stablecoins, and even those emerging sustainability disclosures.
And the rules around the companies, the
Yeah.
CASPs, that provide the services.
Then we dug into the really tough frontiers, like regulating DeFi where accountability is fuzzy, and the whole challenge of cross-border regulation in a global market, thinking about things like reverse solicitation.
And we spent a good chunk of time on protecting users, especially retail investors, the risks they face,
Volatility, scams, information gaps.
and the tools regulators are using: warnings, education, ad restrictions, even those suitability tests.
And then finally, we shifted to the practical side, how businesses are starting to think about actually using crypto in their operations.
The hurdles they face doing that.
And drilled down into that specific example of microtransactions, looking at the tech requirements and some of the cryptos aiming to meet them.
It's so clear that this whole space is just constantly evolving, isn't it?
Absolutely. Innovation is running alongside the regulatory efforts, and the business adoption follows that. It's a continuous feedback loop.
Technology rules and real-world use all influencing each other.
Mm-hmm.
So let's maybe leave you, our listener, with a final thought to chew on after all this.
Okay.
Considering this big global push we've discussed towards more comprehensive regulation rules, getting really detailed, covering investor suitability, even environmental impact,
Right.
and at the same time, seeing growing interest from businesses in practical uses, like making microtransactions feasible, how do you think this complex, often fragmented, global patchwork of rules will ultimately shape your ability to interact with or use crypto assets down the line?
That's the big question, isn't it?
Will all this regulatory clarity, assuming it eventually arrives, actually pave the way for safer, broader, more mainstream adoption?
Or could the complexity, the differences between countries, the potential costs of compliance, could that inadvertently end up limiting access, stifling innovation, and maybe making it harder for everyday users and businesses to actually benefit from the technology?
Something to definitely think about.